Before you invest your first $100, answer one question. What exactly happens after you tap the buy button? That tap can make you a part owner of a real business. It can also expose your money to falling prices, bad companies, unnecessary fees, and decisions you do not understand. In the next few minutes, we will take $100 from your pocket to a complete beginner investing framework. You will learn what a stock is, why prices move, how a brokerage works, how to read a stock page, how investors research companies, and how index funds differ from ETFs. No hype and no stock tips, just the market explained clearly. First, why invest at all? Money has a number printed on it, but it also has purchasing power. Your $100 may still say $100 years from now, yet buy less if prices rise faster than the interest your cash earns. Investing gives money an opportunity to grow alongside businesses and the economy. That opportunity comes with risk. Stock prices can fall and returns are never guaranteed. Money needed for next month's bills is different from money intended for a long-term goal. Before investing, consider emergency savings, expensive debt, your timeline, and your ability to tolerate losses. Now let us examine what a stock represents. Imagine a fictional company called Atlas Home Energy. It designs smart batteries that help homes store electricity. Demand is growing and Atlas wants to build a larger factory. To raise money, it divides ownership into millions of units called shares and offers some to investors. When you buy a share, you become a shareholder. You do not personally own one battery or a corner of the factory. The corporation owns those assets. You own a fractional interest in the corporation and receive the rights attached to your shares. When a private company first offers shares to public investors, the event is called an initial public offering, or IPO. Newly offered shares are sold in the primary market where the company can raise capital. Later, most trading occurs in the secondary market where investors trade with one another. Common stock may provide voting rights and participation in growth. Preferred stock often receives dividend priority but usually has limited voting power. How can a shareholder make money? Suppose Atlas trades at $25 per share. Your $100 buys 4 shares. If the price rises to $32, your position becomes worth $128. The $28 increase is an unrealized gain until you sell. Once sold, it becomes a realized gain. Some companies also pay dividends, distributing part of their earnings to shareholders, but dividends are not guaranteed and can be reduced or stopped. The process also works in reverse. If Atlas falls to $15, your 4 shares are worth $60. Ownership lets you participate in success while exposing you to failure. Public stocks trade through exchanges such as the New York Stock Exchange and NASDAQ. Think of an exchange as an organized electronic marketplace. Buyers submit prices they will pay, sellers submit prices they will accept, and trades occur when orders can be matched. The highest current buying offer is the BID. The lowest current selling offer is the ASK. The difference is the bid-ask spread. Prices move as supply, demand, and expectations change. Earnings, competition, interest rates, regulation, and economic events can all affect what investors are willing to pay. To access that market, most people need a brokerage account. A broker is a regulated firm that receives your order and routes it for execution. Do not choose a broker only because its app looks attractive. Compare regulation, FEEs, available investments, fractional shares, security, and local investor protections. You may choose between a cash account, which uses deposited money, and a margin account, which allows borrowing. Margin can magnify losses and adds interest costs, so it is not a feature to activate casually. When placing a trade, the order type matters. A market order prioritizes quick execution at the best available price, but the final price is not guaranteed. A limit order sets the highest price you will pay when buying or the lowest price you will accept when selling. It provides price control, but the order may never execute. Now imagine opening the Atlas stock page. It looks like an airplane dashboard, but only a few readings are essential at first. The ticker symbol is the short code identifying the security. Let us give Atlas the fictional ticker AHE. The share price tells you the price of one share, but it does not reveal whether the whole company is cheap or expensive. For that, look at market capitalization, or market cap. It equals the share price multiplied by outstanding shares. Suppose Atlas has 160 million shares priced at $25. Its market cap is $4 billion. A rival may trade at only $8 but have 600 million shares, creating a market cap of $4.8 billion. The $8 stock has the lower share price, yet the company has the larger market value. Volume shows how many shares traded during a period. It can provide clues about liquidity, meaning how readily an investment can normally be bought or sold. The bid-ask spread offers another clue. A narrow spread generally suggests easier trading than a very wide one. You may also see the day's range, previous close, earnings per share, dividend yield, and price-to-earnings ratio. These are clues, not conclusions. Market language now becomes easier. A bull market means broadly rising prices, while a bear market means a broad, prolonged decline. Volatility describes price movement. A portfolio is your complete collection of investments. A holding is one investment inside it. Diversification spreads money across investments. An expense ratio is a fund's annual operating cost as a percentage. Knowing the vocabulary is useful. Deciding what deserves your money is harder. A popular product does not automatically create a strong company, and a strong company does not automatically create an attractive investment at every price. When researching Atlas, ask 5 questions. Is revenue growing? Is the company profitable or moving credibly toward profitability? Is debt manageable? Does the business generate free cash flow after operating expenses and necessary investment? And is the valuation reasonable compared with its growth and risks? Then examine its competitive advantage, such as valuable patents, lower costs, a trusted brand, or high switching costs. Finally, challenge your own argument. Do not search only for evidence supporting a purchase. Look for reasons you could be wrong. That is the difference between research and confirmation bias. Even after careful research, putting the full $100 into Atlas creates company-specific risk. A defective product, failed expansion, or stronger competitor could damage that one position. Diversification reduces reliance on a single company. It cannot prevent losses when the overall market falls, but it can reduce the damage caused by one business failing. This is where index funds enter the picture. An index is a rules-based measure of a selected market. An index fund seeks to track that index by holding a portfolio of securities. Instead of depending entirely on Atlas, one fund may spread exposure across hundreds of companies. Now, separate 2 terms that beginners often mix together. Index fund describes a strategy following an index. Exchange-traded fund, or ETF, describes a fund structure whose shares trade on an exchange during the day. The categories can overlap. An ETF may track an index, and a mutual fund may also track an index. But not every ETF is an index fund, because some ETFs are actively managed or follow narrow themes. When comparing funds, examine the strategy, holdings, concentration, expense ratio, trading cost, and local tax treatment. Hundreds of positions do not guarantee balanced exposure. Before investing, avoid 5 common mistakes. Do not invest emergency money. Do not buy only because a stock is trending. Do not confuse a low share price with a low valuation. Do not concentrate everything in one company. And do not use margin or leveraged products before understanding the risks. Also, be careful with panic selling. A falling price does not automatically mean you should sell, just as a rising price does not automatically mean you should buy. Return to the business, your original reasoning, timeline, and risk limits. Finally, remember that fees and taxes affect what you keep. Suppose your $100 grows to $130 and you sell. The potential capital gain is generally the $30 difference after adjustments, not the full sale amount. Dividends may also be taxable. Tax rules vary by country, account type, income, and holding period. Check official local guidance or speak with a qualified professional. This video is general education, not personal financial or tax advice. Let us complete the journey. A stock represents ownership in a corporation. A brokerage provides market access. Market cap reveals more about company size than share price alone. Individual stocks require research and acceptance of company-specific risk. Index funds and ETFs can provide diversification, but they still carry risk. And the return that matters is what remains after losses, fees, inflation, and taxes. Your first goal should not be getting rich quickly. Your first goal should be avoiding decisions you do not understand. Comment with the term that finally became clear today: stock, ETF, or index fund. Subscribe, because in the next video, we will learn how to examine revenue, profit, debt, and cash flow without needing an accounting degree. Keep learning, invest carefully, and I will see you in the next video.